Keeping an eye on shares of Blue Owl, you can see it and other alternative asset managers stocks have been under pressure. This certainly was the case yesterday after the firm said it would halt quarterly redemptions in its retail-focused debt fund, opting instead to return capital via episodic payouts, as it did sell down $1.4 billion of assets to allow for that. The move did reignite concerns around liquidity and valuation for many private credit vehicles. Joining us now in a CNBC exclusive is Blue Owl Capital co-president and the head of credit as well, Craig Pecker. Craig, good to have you here. Thank you for being here.
Great,
as well.
Thanks for having me.
I want to start off with the $1.4 billion because today's story, or the focus on Blue Owl now, has been around the sale itself. And I guess my first question would simply be, did you sell a cross-section of loans from across Blue Owl? So, you know, whatever percent of this and this and this, whether sector or companies, or was it you cherry-picking the loans that were a particular, value, and therefore you could sell at what was 99.7 cents on the dollar?
Yeah, no, thanks for having me, and thanks for the opportunity to clear it up, because I think there was a lot of confusion, in part because the headline said we were halting redemptions. We're not halting redemptions, just changing the form, and if anything, we're accelerating redemptions. But to your question,
yes,
we sold $1.4 billion across 128 names in the portfolio. It represented a cross-section of about half the book, generally consistent with all of our industry sectors, all the types of loans that we make, and we sold them at par. Fair value, 99.7. I think most in the industry that follow this say the ability for us to sell that size at these prices is actually a validation of value. And people have been asking questions about marks, and here we are with significant third-party sales at par.
So again, right, to that point, then you would argue this is a reflection of the overall credit quality of the portfolio, not you selling what you knew you could sell.
We had ample demand for these names. We certainly, as you know, this particular transaction is a result of us calling off a merger of one of our smaller funds. In November, I was here.
I
said we have a number of options. We're going to come back relatively quickly and outline those options. This fund originally was raised about 9 years ago. The plan was either to IPO it, merge it. We tried to merge it, wasn't the right time. Or the third option was to return the capital to investors. We wanted to accelerate the return of capital to investors, so we opportunistically chose to sell a fairly sizable chunk. It's about 35% of the fund, OBDC2, and instead of doing a 5% pro rata tender for investors, where they have to choose whether to sell or not, and it can place investors that don't tender in a disadvantaged position. We said if a fund is more in a return of capital mode, it's much wiser to do it pro rata, but also, and this just wasn't picked up, we're returning 30% of the capital, 6 times the amount that we would have otherwise been doing.
Understood. I want to get to this question around gating, but let me finish on the sort of the loan portfolio if I can. Because you did sell some of them to a wholly owned subsidiary, an insurer you own, and that has also raised questions as to why you would do that, because it does, again, you're like, well, why do they need to sell it to them?
Yeah. So look, I really appreciate the chance to be here. We don't own an insurance company. It's not a subsidiary. And we haven't disclosed the name of the institutions. They've asked us not to use their names. I know there's some reporting out there at the respect of our clients. We haven't done so.
So is that reporting incorrect then?
I'm not going to.
I mean, the name, again.
No, it's very key.
But here's it's not key, and here's why. We sold it to 4 institutions. They all bought the same amount at the same time at the same price. The fact that one of the 4 might be part of our insurance business, how is it reasonable that that would undermine the other 75% of the sales? And I will tell you, each of the 4 had appetite to buy more. The fact that we have an insurance business, if we were to sell 25% of it, I mean, there are clients, just like the other clients.
Well, the complaint is that it's moving assets into another not transparent part of the non-banking industry, and it's highly levered, and the transparency suffers as a result.
So, again, back to transparency. I think the most transparent thing we can do for the investors in our funds is to have actual sales at actual prices. The clients that are in this fund in 45 days are going to get 30% of their money back.
But to Carl's point, the other one, why not just sell to the third parties who are clearly third parties? Why even raise this question given all of the focus right now on the credit quality of the portfolio overall?
Honestly, I'm surprised that the fact that we sold it to 3 other very high quality investors is somehow being impacted by the fact that we sold it to a client. They're not part of Blue Owl. They're money we manage for insurance companies, and it's just 25%. We were not doing this exercise to validate our marks.
Right.
We very much wanted to return capital, and the fact is these assets were worth par, and we got par. And we will continue to get returns for our investors at the value of our investment.